The Policy Initiative for Economic Development is a newly established economic and policy think tank with the sole aim to creating the necessary platform for professionals, experts, and consultants to meet and discuss, analyze, and provide alternative yet credible policy directions to government and the business community. The Institute will equally focus on political leadership across the continent of Africa. The recent development in the banking sector demands that we organize this roundtable conference so that participants can recommend strategies necessary to develop a robust and resilient financial sector, capable to stimulate economic activities as well as propel economic growth and development. More importantly, we wanted to see our indigenous banks growing to become a vehicle which can give out loans to support huge, medium, and long-term projects, infrastructure projects within the domestic economy as well as the continent of Africa. I think it's expedient for us to start the discussion with a big question. Who is in charge of the banks? It's interesting to note in Ghana, that is the central bank, that's the Bank of Ghana. And thank God we have Dr. Otto here, to give us the state of the banking or some few, insight about the banking sector. In France and Belgium, ladies and gentlemen, the case is quite different. They have a banking commission, and in Switzerland, it is the Federal Banking Commission. In Japan, the Financial Services Agency is in charge of the banks. In the US, quite a different picture. We have the Federal Reserve, we have individual states, we have the Federal Deposit Insurance Corporation, the controller of the currency, and the Savings and Loan Associations reporting to the Federal Home Loan Bank System. So in the USA, it's not the central bank, but they have the respective agencies that handles banking issues. Generally, the central banks or any other supervisory body set rules for commercial banks. That is, conditions of entry into the industry, capital ratios, liquidity rules, large exposure rules, foreign exchange control, and rights of inspections, among others. Just recently, the Bank of Ghana has increased the minimum capital requirement for the banks. And from all indications, it is evidently clear that most of our local banks must have to work hard to meet the deadline. Personally, I believe there are three options for the banks to exploit. One, raise more capital from existing shareholders. They could consider right issues and the like. They can as well reduce their assets by selling off their other branches to other banks, if appropriate and possible. And then the last one, which is a merger, which I've been calling since 2015. I see a merger as an option because we don't want foreign investors to come and take over our local banks. We want to maintain our local brand. And when you have local banks in your economy, it becomes a vehicle in propelling economic growth and development and supporting government projects and agenda. The 21st century global competitive business environment is ever-changing and highly driven by technology and innovations. As a result, business organizations, more importantly, the banks, cannot afford to stick to traditional banking and business. They must develop innovative products which will serve the needs of the larger banking population, as well as to attract unbanked population. It is important to acknowledge that the financial sector in Ghana is faced with a series of key challenges. Notable among them include cost of doing business, that's their cost control, growing competition among themselves and other financial institutions. We also have the telecos now competing with them, through mobile money transfer and then the like. So my mommy told me the last time that he has never visited the bank ever since they introduced the mobile money transfer, because it's a matter of wiring through the mobile bank and then she will receive it in the village. And the use of information technology and the high rate of non-performing loans. It is my hope that at the end of this conference, we shall come out with strategies to building a robust financial sector, which will be presented to the regulator. And thank God we have a senior rep from the regulator for possible consideration.
It is good to start by reminding all of us that the bank is mandated, as contained in Bank of Ghana Act 2002, at 612, as amended, to pursue sound monetary policies aimed at, 1, maintaining stability in the general level of prices. Here, when we are talking of prices, we are talking of the general level of prices, including exchange rates and interest rates. 2, ensuring efficient operations of the banking and credit system. Let me pause here to explain. When we are talking of the financial system is generally broad. We can identify the insurance sector, the stock market. We can also identify pensions as part of the financial system. So the Bank of Ghana, strictly speaking, is only responsible for the banking and credit system. 3, supporting general economic growth. In line with its mandate, the bank is taking measures to ensure price and financial system stability. The bank, through its inflation targeting framework, has succeeded in arresting the recent hike in inflation and returning the economy to the disinflation path. However, there was a blip in the 3 consecutive months of declining inflation, as consumer price inflation rose from 11.9% in July to 12.3% in August, driven by both food and non-food prices. Similarly, the bank's measure of core inflation, which excludes energy and utility price changes, went up from 12.6% in July to 13.1% in August. Mr. Chairman, ladies and gentlemen, we can all recall that the monetary policy stand has eased in line with declining inflation and underlying inflation pressures since the beginning of the year. However, based on its assessment of risks to inflation and growth, the MPC at its 78th meeting decided it was time to pause the easing cycle. The committee also noted that it will remain vigilant and committed to responding and taking the necessary policy actions if the current underlying inflationary pressures persist. Mr. Chairman, regarding financial or banking and credit system stability, the bank has taken some measures recently. First, the bank announced a new minimum capital requirement as part of a holistic financial sector reform plan to further develop, strengthen, and modernize the financial sector to support the government's economic vision and transformational agenda. As a first step, the bank revoked the licenses of 2 insolvent banks, we know UT and Capital Banks, to ring-fence a potential spillover threat to the rest of the financial sector, and also to prepare the grounds for other reforms. At the same time, the Bank of Ghana has agreed with identified banks a roadmap for recapitalization in accordance with the capital restoration plans stipulated by the Bank and Specialized Deposit Institutions Act 2016 at 930. We are all aware that the bank revised upward the minimum paid-up capital for existing banks and new entrants from 120 million Ghana cedis to a new level of 400 million Ghana cedis, effective Monday, September 11, 2017. The bank outlined the following conditions for the recapitalization. Commercial banks will be required to meet the required minimum capital through A, fresh capital injection, B, capitalization of income surplus, or C, a combination of fresh capital injection and capitalization of income surplus. What it means is that if you are a bank, you are expected to meet the new minimum requirement of 400 million by December 2018. And we are saying that you can do that by bringing in fresh capital. Or if you have income surplus adequate enough, you can recapitalize that, your income surplus. Or if your income surplus is not up to that, you can bring in fresh capital and then part of your income surplus. So those are the options. Banks are not allowed, that's it, 2. Banks are not allowed to capitalize revaluation reserves on financial instruments through other comprehensive income statutory reserves, credit risk reserves, and unaudited profit. 3, all existing banks have up to December 31st, 2018 to meet the new minimum paid-up capital requirement. Mr. Chairman, broadly, the financial sector remains liquid and solvent. Total asset base of banks increased to 89.1 billion Ghana cedis in July 2017, representing an annual growth of 32.9% compared to 24.6% growth a year earlier. The growth in assets was funded largely by domestic deposits, which went up by 32% on a year-on-year basis. The industry's capital adequacy ratio averaged 14.3% at the end of August 2017, above the 10% statutory threshold. This notwithstanding, there are some notable challenges to effective intermediation of the banking system. These include high non-performing loans and concentration rates. The high exposure of the banking system to the energy sector is partly to blame for the high NPLs, which reflects in high risk premium that fits into high lending rates of banks. Some have been questioning the slow response of lending rates to the recent easing of monetary policy stance. Although there is usually some lag in the response of market rates to the policy rate adjustments, the slow response of lending rates observed in our case in recent times is underpinned by the high NPLs of the banking system. Mr. Chairman, we also have a challenge regarding the minimum capital requirements. People have been asking, how will banks be able to meet these requirements by December 2018? And some people have been expressing fear that if we don't take time, foreign banks will swallow domestic ones through mergers and acquisitions. Yes, there are several options for the banks to take. As I have mentioned already, they are supposed to bring in either fresh capital, or if you have income surplus, you can recapitalize it, or you bring some fresh capital or and add some income surplus, a combination of the two. But the issue we have to resolve here is when it comes to meeting the minimum paid-up capital by December, we are saying that when you are bringing fresh capital, yes, it can be mergers, it can be through mergers and acquisitions. But the local banks can strategically position themselves. The bank is ready to help in this direction, to guide the process. Another option left for the banks is to go to the capital markets, to go and raise capital from the stock exchange. It's very critical because the bank is interested in seeing more local participation in our banks. We have a lot of foreign banks. Our desire is that even the foreign banks here will list on the Ghanaian stock exchange. Because by so doing, the Ghanaians will also benefit from some of the profits that they earn. So the options are there for the banks to take. The bank, as I said, the bank is ready to guide the process. Mr. Chairman, another challenge is the slow pace of credit expansion in response to policy easing. Of course, this can be partly explained by the high NPLs mentioned above. We also have a challenge of effective risk management and corporate governance issues. Mr. Chairman, the bank is taking its regulatory and supervision functions seriously to ensure that the banking system is sanitized for efficient and effective financial intermediation. The ongoing recapitalization and the implementation of Basel II and III are intended to deal with some of these challenges. These involve implementation of macro-prudential regulations and ensuring proper corporate governance structure for our banks. I'm also happy to note that the government is committed to floating 10 billion energy bonds and then implementing ESLA accounts to help in defraying the energy sector indebtedness to the banking sector. We know that when this is done, the MPLs will come down. As far as I know, I don't think the central bank is ready to give money to any commercial bank to meet its minimum capital requirement. What we are saying by way of assistance or by way of guiding the process is that if it comes to mergers and acquisitions, what can we do? We are at the apex of the banking sector. We know what happens. So if you want to merge with another bank, we have to look at the strength of the two banks that want to go into the merger. So those are the things that we are talking of. So we know which banks, if we are talking of mergers and acquisitions, what combinations, which banks should merge with which banks. Those are the things that we are talking of as guiding the process, but not to give money to the commercial banks. The second point here is about the stock market, UT Bank. As far as I know, the shareholders' money is intact. It's not lost. Only GCB took some selected assets and then deposits. But we know that PricewaterhouseCoopers, they will be in charge of other liabilities and all those things. So shareholders' funds are not lost. The banking supervision, the head of banking supervision department was on air to explain some of these issues here some time ago. Clearly, you see, the UT and the capital banks were not the only banks that were having challenges. There were some other banks equally having challenges. And as a regulator, we have invited them and we have given them time, adequate time, to restructure and then move to a positive position. They should move from their red position to a green position. Some banks managed to do that, but UT and Capital Bank failed to meet the deadline. But of course, as regulators, you see, there is one thing that we are careful about. We don't want a spillover effect of that. We don't want a bank run. If we allow UT and then Capital Bank to collapse, there could be a run on other banks. So we engage here the players in the industry, those whose books are looking good to take over. We invited them, and then GCB was selected to take over. So it's not a one day. You see, the announcement came one morning, and then everybody was alarmed. But what was going underground was going here for over 6 months, up to 1 year. You see, so those are the things. So it's not that, you see, we have not come to the public to make those things known to the public, because if we did, there will be a run on other banks. So that's why it appears that out of a bloom, then the central bank is revoking the license. No, it's not a one-day affair. Right. We had a series of consultations with them. That no central bank anywhere tried to prevent collapse or bankruptcy of banks. It is not the responsibility of the central bank anywhere in the world to be preventing If the board of directors, if the managers are not here taking due cognizance of the risk factors. They are engaging in reckless operations and all that. There is nothing any central bank anywhere can do than to allow the bank here to go. Because you have guidelines, you have directives as to how to operate. So, in effect, when you're operating, you're supposed to operate according to the guidelines. So banking supervision, what the banking supervision does is to ensure that, yes, your operations are in line with the guidelines. When you're not conforming, we'll call you and warn you. So after several warnings, if you persist, what else can the central bank do? That's the issue. So there is no guarantee. The central bank cannot sit here now and say that I'm giving a guarantee that no bank will collapse in future. No. That one, no bank, no central bank will do it anywhere in the world. Because what will trigger the collapse of any bank will depend on how the bank is run. Yes, will depend on how the bank is run. The central bank does not run here. The commercial banks. We only supervise. We only regulate.
Yeah, but they can't
Thank you.
look on for a bank to collapse.
Yes. We can look on for a bank to collapse anyway. That's why, at times, like the measures that we have taken.
If you do that, then you have failed as a central banker.
Yes. No, what I'm saying is, no, don't get me wrong. What I'm saying is this. You see, if a bank is going down, what we can do to prevent systemic risk, we will do it, as we have done in the case of what? UT and what? Capital Bank. But you see, we cannot give a guarantee that no bank will go down in future. No, that one, no central bank can do that. No central bank can give a guarantee. Simply means that they have met the requirement, our requirement, so we are not expecting any further revocation of licenses here. They will have met the requirement. Now, just to react quickly to some of the issues here. I've said in my presentation that the Bank of Ghana, in implementing Basel II and Basel III, will be paying attention to the governance structures of the various banks. So like the internal audit and all those things that my friend here was talking about, they will all be part of the governance structure. You see, we put people on board, they have conflicts of interest and all kind of things. We want to deal away with all those things. So we are going to insist on proper governance structures of our banks.
The banking sector in Ghana has seen some remarkable growth over the years. Despite the general economic challenges, such as the decline in the local currency, the rise in government debts, swollen non-performing loans, as well as over 300 increments in the capital requirement by the Bank of Ghana. In order to be in a position to meet the growing needs of the country and making the banking industry relevant to businesses, it is important for all industry players to fully comprehend these challenges so as to be in a better position of finding workable solutions to them. For the purposes of this discussion, emphasis will be placed on non-performing loans and the new minimum capital requirements by the BOG. Per the definition of the International Monetary Fund, that is the IMF, a non-performing loan, if a loan is said to be non-performing and problematic, when the payment of interest and principal are past due by 90 days or more, or at least 90 days of the interest payment have been capitalized, refinanced, or delayed by agreement. According to July 2017 Bank of Ghana Banking Sector Report, Volume 2.3, the key risk to the banking industry is the higher stock of impaired assets to the total loan as measured by the non-performing loans ratio. The industry NPL ratio increased between 2016 June and June 2017. This increment is driven by the energy-related and other large non-oil-related exposures. The financial sector plays an important role in mobilizing financial resources for investment by extending credit to various businesses and sectors. Like any other businesses, success of banking is assessed based on profit and quality of assets it possesses. Lending represents the heart of the banking industry, and loans are the dominant asset as they generate the largest share of operating income. Loans, however, exposes the banks to the greatest level of risk. Prudent credit risk measurement and creation of adequate provisions for bad and doubtful debts can cushion the bank's risk. However, when the level of non-performing loan is high, the provisions are not adequate protection. Performance in terms of profitability is a benchmark for any business enterprises, including commercial banks. However, increasing non-performing loans have a direct impact on profitability of banks by diluting returns on assets. Non-performing assets, therefore, have negative effect on returns on assets, a measurement of profitability. Non-performing loans erode banks' profitability in that banks could incur heavy disposal expenses. Non-performing loans assets have opportunity cost in that non-interest earning assets, mainly in the form of money, could have been invested elsewhere and provided earnings. Besides this, banks are also required to make provisions for losses on non-performing loans, which in turn affect profitability and its associated costs. Batra 2003 stated that focusing on non-performing loans leads to credit risk management, assuming priority over aspects of bank's function. The bank's whole machinery would thus be preoccupied with recovery procedures rather than concentrating on expanding businesses. The most notable impact of NPL is change in banks' objects, which may hinder credit expansion, which will result in many banks inclining to invest more in risk-free investment to avoid risky ventures, which in the end will negatively affect the economy. Normally, we call this armchair banking. Broadly speaking, there are three main methodologies to deal with excessive NPLs, and these can be done by creation of an asset management company to take over all bad loans in the balance sheet of banks, securitization of non-performing loans, and debt restructuring. Banks, on the other hand, can resolve their non-performing loans problem more intensively by applying some of the already known measures of debt restructuring. The most commonly used measures by banks is loan rescheduling. That is, modification of maturity dates, rarely changing interest rate, write-off of default interest rate, or reducing the debt principal. Beyond the traditional approach that has been tried and did not prove quite successful, government should help in improving the whole ecosystem in Ghana by addressing the address system, looking at the legal framework, improving monitoring system, and enforce financial institutions to send data to the credit reference bureaus. Credit information such as a person's previous loan performance is a powerful tool to predict his future behavior. Such credit information institutions reduce the effect of asymmetric information between borrowers and lenders and alleviate problems of adverse selection and moral hazards. Another way of effectively handling the challenges of non-performing loans is adopting the asset management approach, which is a process that involves identification of non-performing loans, taking specific decisions to resolve them, and implementing the decisions so the problem is corrected. This can be achieved by setting up a special purpose company as an asset management company to facilitate restructuring viable financial institutions which are burdened with NPLs problems. By legally, financially, and operationally separating and taking over bad loans from the financial institutions. This is what government should do through the instrumentality of legislative acts to be championed by the BOG. The benefit of this arrangement to the banks and government cannot be quantified in changing the face of banking in Ghana. Also, the banking sector could consider adopting the World Bank's Podgorical approach, which aims to achieve greater stability for the banking sector, as well as revitalize lending activities to economically viable companies. After the analysis of the borrower's financial situation, Financial institutions should consider the possibility of financially restructuring debt or the entire corporation. The restructuring plan must show whether the creditors have real possibilities for the settlement of their claims and the borrowers the ability to service their debt regularly. Financial restructuring should be based on a well-designed restructuring plan for each individual loan, which should contain financial information about the borrower, its business activities, and the guarantor, collateral valuation, define appropriate measures of financial restructuring, and adequate legal documentation that enables a change of deadline for loan repayment. On the new minimum capital requirement by the banks, which is affecting everybody, and we know that in no time the Bank of Ghana will come up with savings and loans and microfinance institutions. That is what they normally do anyway. They will start with the banks and then calm down a bit. All of us from the industry are waiting for your announcement on the savings and loans and the microfinance institutions. We are ready for you people.
Thank you.
The importance of adequate capital in the banking sector cannot be overemphasized. Banks play an important intermediation role in the economy. In fundamental terms, banks take on deposit, incurred liabilities, and provide loans and advances, which we term creating assets. From undertaking these activities, banks would make a profit and retain some of its profit to boost its capital strength, distribute some to providers of capital, or make a loss. For the conduct of both activities, banks require adequate capital to provide comfort and satisfaction to both customers and the regulator of the industries, and also to achieve confidence in financial services system. In September 2017, the Bank of Ghana hinted on its intention to formally direct banks in the country to recapitalize to $400 million, equivalent to about $100 million. This would represent an increase of over 200% over the old capital level, which was 120 million, and would be Ghana cedis, please, and would be the biggest capital increase witnessed over the banking landscape. The first time in the last decade where the banks in Ghana were required to raise their minimum regulatory capital was in 2008, if I'm right. The regulator increased the minimum regulatory capital from 7 million to 60 million Ghana cedis. So it looks like the 400 and the 120 is not anything. You are from 7 million to 60, and now from 120 to 400. Then you didn't even increase it well. Yeah. I think so. According to the Bank of Ghana, banks would be giving up to December 2018 to come up with this capital. Among the many advantages stated as increase in capital requirement is expected to position banks to finance large infrastructure projects requiring billions of Ghana cedis and make the industry more resilient across business circles. Thus, in case of any financial crisis due to government debt distress, a higher capital requirement will reduce the negative impact on the economy. However, the belief that banks could be made much safer at easily no economic cost by requiring shareholders to increase their funding for banks whilst reducing the current high dependence on debt or deposit need to be debated heavily before consideration by the central bank. An increment in minimum capital requirement implies that the barrier of entering into the industry will be made a lot harder. It may also cause some existing banks to fold up or merge with other banks so as to meet the new minimum requirement. It is said that when microfinance institutions, this is not part of my speech, grow, they become savings and loan. And when savings and loan grow, they become banks. So when the normal universal banks grow, they will become central banks? I don't know what they will become. The net effect will be a reduction in the number of banks as well as the level of competition in the banks, which may fuel interest rate and bank charges. Changing regulatory capital requirements affect banks' capital ratio and lending. Banks are keen to keep unchanged their buffers of capital above the regulatory minimum and tend to rebuild these excess capital buffers over 3 to 4 years. Banks respond to increased capital requirements by reducing lending more to the real estate sector, including household and commercials, and less to other types of lending. In dealing with the possible changes of the new minimum capital requirement for banks, institutions within the financial sector can adopt some strategies. The first one should target the bank's retained earnings. Banks could seek to reduce the share of profit they pay out in dividends. Alternatively, banks may try to boost profit. The most direct way to do so would be by increasing the spread between the interest rate it charges for loans and those it pays out on funding. Whilst competitive pressures may limit how much an individual bank can widen this spread, lending spread could rise across the system if all banks followed a similar strategy and alternative funding channels, such as bank markets, did not offer more attractive rates. Other ways to increase net income include increasing profit margins on other business lines, such as custody or advisory services, and reducing overall operating expenses. A second strategy is to issue new equity, such as through a right issue to the existing shareholders. An equity offering on the open market or placing a block of shares with an outside investor. This is likely to be the least attractive option. However, given that a new share issue tends to reduce the market value of the existing shareholders. A third set of adjustment strategies involve changes to the asset side of the bank's balance sheet. Bank can run down its loan portfolio or sell asset outright and use the proceeds of loan repayment or asset sales to pay down debts. Less drastically, they can slow down lending growth, thereby allowing retained earnings and hence capital to catch up. In some cases, an asset sale can boost capital through an accounting gain, as the assets are revalued relative to their purchase cost. Finally, banks can seek to reduce their risk-weighted asset by replacing riskier, higher-weighted loans with safer ones or with government securities. In conclusion, it must, however, be noted that banks' choices from among these various strategies would determine the macroeconomic impact of an increase in regulatory capital ratio. For example, if the banks seek to reduce lending or reduce lending to riskier projects, this could constrain investment.
Are we giving as prescription to make the financial system resilient? Are they evidence-based? No. So we just cut and paste policies. We have been talking about in US, in UK, in Bangladesh, wherever. But can't we make use of our own data? Can't we analyze our own data based on the data? We inform policies. Cut and paste prescriptions may not work for our financial sector. So my main point is that there's a need for research. The financial sector needs to collaborate with the academia to conduct evidence-based research using our own data. So as part of it, data is a problem. Banks are never prepared to share information with those of us in academia. We are not competitors. We are researchers. So what happens is there's going to be a win-win situation. I use the report for my promotion, and then I give you the policy brief. Whatever you need, not the entire, paper, but the key issues that are relevant for you. So based on that, you can also make some you can also make some policies that will work. One thing that I see about the entire financial system is that if you look at the pyramid of the financial system, at the base we have the money market, at the middle we have the capital market, and at the apex we have the derivative market. That's where we are advancing where we are becoming more, we are developing. It looks as if the Ghanaian financial system is bank-based. And because bank-based, there is limited long-term financing. So there's a need for us to balance between bank-based, bond-based, and then insurance-based market. We realize that the contribution of insurance to GDP is less than 2%. And it is on the capital market that firms can get cheaper funds, that firms can get long-term financing. And we can do a lot of research to find out how we can make use of the capital market to accelerate economic growth. I am focusing on research. Again, we need to revisit financial inclusion, that agenda. A study by FinScope, I hope you all know FinScope, indicates that informal products and mechanisms used are mostly informal savings products, about 71.6% of households. Credit products, 20.2%. Informal remittances, 15.9%. And insurance products, 4.7%. So you see that the level of financial, a lot has been done, but there's still more to be done in terms of financial literacy, in terms of inclusiveness. Other than that, it will be difficult for us to link the informal sector to the formal financial system. So that is where we see microfinance playing a key role. But in recent times, a lot of us have had negative perception of microfinance. Anytime you mention microfinance, people see it as a, yes, as a devil, because of a few cases, DKM, and then here a lot of the blame could be apportioned to the regulator. Christian, I hope you are listening. To the regulator, in the sense that it looks as if BOG didn't have the capacity even to regulate microfinance institutions. In some countries, microfinance regulation is in the hands of specialized agencies. Yes. I've done a literature of regulation of microfinance in so many African countries. The central bank are not heavily involved in regulation of microfinance because they don't have that capacity. Even the commercial banks, you see, they are failing. A chunk of rural banks are in distress. As I speak, go to central region, we have so many rural banks that are in distress. Ashanti, Brahafu, many of them are in distress. So, I think we need more research into these areas. What is happening in the banking industry? What is happening? Let's revisit financial stability. It's one of your key, objectives, key mandates. And we can only do that through research. So as we meet here today, I want us to think through how we can promote research in the financial sector, how we can collaborate with the academic institutions. At the University of Cape Coast, we have a center that is in charge of data archiving, where banks, we can host data of these banks, and data will be assessed by everybody. We go to a website. Currently, I'm trying to look at why monetary policy is not impacting on lending rate. For me, monetary policy in Ghana is not effective. Because theoretically, if monetary policy will be effective, it should pass through interest rate, not just inflation. Some time ago we were talking about monetary aggregates. Now, IT, inflation targeting. What is the effectiveness of monetary policy when it is not able to, pass through, influence interest rate, and then have impact on economic activities? It's not being effective. what is happening. I understand you that there could be some time lag effect, but if we have been experiencing this over and over, so what is the time lag? So if BOG can give us money, the UCC, yes, what the policy maker doesn't know is how long does it take? How long does it take for monetary policy to have effect on lending rate? We can do that for Bank of Ghana. How long does it take? So that we are interested in estimating the lag effect. Because there seems to be no link between the monetary policy and then lending rate. And once that link is not there, you cannot convince me that monetary policy is effective in this country. Recently, when the Vice President inaugurated the BOG team, that was one key thing that he challenged the BOG board. He said they should find ways of making monetary policy work in Ghana. So our doors are open, and we are prepared to do that. You go to the website, you try to download bank data to make some research. There are a lot of gaps. The data is sitting somewhere, but we won't have access to it. The data that's in the public, that data is not credible. There are so many figures in Ghana. For GDP alone, you can have about 3 figures. We have political figures, we have figure for the president, figure for the governor, figure from GSS. So sometimes people will talk about different figures on the same variable. So we need evidence-based research. If you want to build a strong financial system, a robust financial system, a resilient financial system, we cannot cut the academians out of it. So provide us with data, let's do analysis, let's come on board, provide us with funds. The banks have the money. Give us the money. We can do both quantitative and qualitative research. We interview, because some of these things, for example, why monetary policy is not effective, it might not be an issue of time series. Let's interview the policymakers. Let's go to Ministry of Finance. Let's go to CEOs of banks. Let's go to the ministries and find out from them, why is monetary policy not working in Ghana? Why is monetary policy not reflecting in lending rate? Ghana is one of the countries with the highest margin or spread, we all know. So, Chairman, thank you for the opportunity. But my main take-home message is that we need evidence-based research in order to build a stronger financial system. Thank you.
Presentation. The key issue is research-based, evidence to support. And I mentioned about the data, available data to be able to make an informed decision.
And collaboration
with academia. And that's the reason which the policy initiative for economic development is in session. We want to partner with all stakeholders, as well as we have the professional bodies here, and that's the reason which they've invited. We want to work hand in hand, so that once academia provides us with the academic aspect of the thing, we also take it from the professional perspective and analyze it. We have our heavyweights behind us, and then together we can have a very solid system. I believe Ghana, we have what it takes to have a very robust and resilient financial sector to support economic activity.
We also have open market operation as a tool we use. But the policy rate is the key tool. Anytime the MPC, the Monetary Policy Committee, meets, they take a decision on the monetary policy rate. And that's what is announced. Now, the issue is that when you have inflationary pressures in the system, what you do is you hike the policy rate. And when you hike the policy rate, it translates into the rising of market rates. Market rates are adjusted upwards accordingly. Now, the challenge we have in our part of the world is that anytime you have inflationary pressures and the policy rate is adjusted upwards, you see banks responding quickly to that upward adjustment. The lending rates are adjusted upwards quickly in no time. Yes. But when we are on a deflationary trend, deflationary path, and then the central bank decides to be easing its monetary policy stance by reducing the policy rate, it takes a long time. And my friend was talking about ineffectiveness of monetary policy and all those things.
Off record.
Oh, yes. No problem. It's an issue. We at the bank are concerned about it. In fact, even at the last MPC, the one they issued a press statement yesterday, we had it from Tuesday. There's a you see, this is how it works, the process, because I am involved here. I'm part of the process, even though I'm not MPC member. But the MPC meets the staff prior to its meeting. We provide a technical input into the deliberations. Then on Friday, then they meet to take their decision, and then on Mondays they announce the rate. Now, it is actually a concern for the central bank, because when the economy is not growing, when the real sector is not impacted, we have a concern because it's our mandate to support economic growth. So when the Monetary Policy Committee meets, we ask all these questions. In fact, we make presentations concerning the external sector development. We look at the exchange rates developments across the world. We make input concerning the balance of payment development. What is the reserve position of the country? We make that. We look at the real sector, even though we don't have adequate statistics from the statistical service regarding the growth rate of the economy. But you recall that the bank has developed its own index called Composite Index of Economic Activity, SIA. So we develop on that. We conduct surveys, and then we develop an index. We use those things to gauge the performance of the real sector. We conduct what we call market surveys for inflation expectations, consumer expectations, business expectations, financial sector expectations. All those studies here are presented to the MPC. Not only that, we look at the monetary sector development, we look at the financial sector, the stability, the ratios. We discuss all those things. So when the Monetary Policy Committee takes a decision, it's not just here. They look at so many things, so many variables before taking a decision. And in all our presentation, we try to assess the risks to growth and the risks to inflation. Now, anytime the MPC is taking a decision, its prime or the priority is on prices, because that's the primary mandate to stabilize prices. So when you assess the risk to growth and to inflation, you have to see where the risks are tilting. Are they tilting to growth or to inflation? Yes. So we make all those things here before we come out with a decision on the policy rate. Now, but coming back to the question on the lending rate. Now, the issue is if you take the lending rates, why it appears, because, as I said, we do a lot of investigations. We do a lot of studies. In fact, even the capital requirements, minimum capital requirements, if you go to the bank, there is a voluminous study that went into it. So it's not just the bank standing up one morning and saying that, oh, all banks should raise here. No. A lot of work has gone into it. But when we come to the lending rates, what we have seen from our perspective is that, you see, you interact with the banks. They will tell you, when you are lowering your policy rates, you expect that the market will respond, the lending rate should come down. But you see most of the banks, they will tell you that the funds that they are using, they've already taken that fund sometime in the past at a certain interest rate. They wanted, you have taken your deposits here from your customers. And in fact, most of it's not the small decent. It's institutional investors. You have monies from corporate institutions, SNEEDs and others. When you are taking that money, you are not taking the money from those institutions at 2% or 3%, because you have a treasury bill over there. Those institutions could offer to send their monies or to put their monies in treasury bill. So if a bank is requesting those corporate institutions to put their monies at their disposal, what they have to entice them. So it is at T-bill rate plus a certain percentage before those institutions can put their money with you. Now, if the banks are using those monies for transaction to lend to the public, and you are reducing your policy rate, it will take time. So the banks already, they have taken money from corporate institutions with a promise that will give you this interest rate, and they are using those funds. So it is very difficult for the lending rate to adjust immediately as the policy rate is going down. You see, so those are some of the challenges that we have. The banks will also tell you their operational costs and all those things. There are so many other things here that go into it. But now, just coming back to my friend, he's my good friend. We were at UCC together before I left to WAMI, and then now find myself at Bank of Ghana. Luckily, I am in an office we call empirical studies. You see, I'm in research department. But in the research department, we have an office called Empirical Studies and Ad Hoc Assignment Office. Yeah, so like this one is an ad hoc assignment. It was just 6 o'clock yesterday that I was called to be here. Yes. Yeah, that is the nature of the ad hoc assignment. Yeah. But in the Empirical Studies Office, what we do, or one of our mandates, is to collaborate with the academia to carry out research. We are to engage in, to organize seminars, workshops, and all those things. Only that we came in just last year. We joined the bank last year, and then the unit was created just last year. So we are in the process of formalizing all those things. And this year, we have submitted a budget to management. We hope that it will be approved. Once it is approved, we can be sure we will be calling for proposals based on some themes. So we carve some themes, and then we'll be calling for proposals so the academia could participate. So just rest assured, if I remain in that office, we'll work on that.
Our doc did very well by looking at the various issues, as well as Mrs. Charlotte looking at the NPL, and the doc about research. And I think Doc said one thing that to me as a policy think tank we will have to look at it. He said that universal license has been given to almost all the banks, regardless of your color, whether you are a Ghanaian or a foreigner, they expect you to meet the requirement. It's an issue that I have a different perception. I believe that the local participation of either entrepreneurs or banks in the economy is very important. And for that matter, the central bank should have a particular area. That's what I'm saying. That, Doc, it's a concluding remark. When the chairman is concluding that is our position. That we'll have to look at it. It's very important in every economy. I remember vividly when Barclays Bank, what we call the Barclays Bank, was a merger of private banks in the UK, when they had an issue of discapitalization and the rest, and they merged and became a Barclays Bank today. It was, so all these issues are very important that we look at it.